We definitely believe that we're in a higher for longer interest rate environment right now. If you think about all of the policies that are coming out in this new administration, whether it be immigration, whether it be fiscal, obviously, whether it be tariffs, those are all inflationary type policies. We have been in this higher interest rate environment since 2022. The reality of what we're seeing with the rates being higher for longer is exactly what is it intended to do is shift monetary flows away from equity into credit. This creates a really interesting investment environment as we think about the opportunity set for credit solutions. There are so many companies and businesses that were built for this zero interest rate environment. And so there is a massive demand for capital out there in the market that does not have the capability of either accessing the broadly syndicated market, does not have the capability of accessing the regular way high yield market, or the regular way what we'll call commoditized upper middle market direct lending. And so there's a significant demand as a result of this higher for longer interest rate environment for companies to come for solutions-based capital within their capital structure. There's a consistent debate right now between that yield and spread environment. And the reality is spreads are really tight on a historical basis. And the reason being is because yields are still really attractive because of that high base rate. And so what you are seeing is as you're having these natural capital flows coming into fixed income in order to capitalize on these higher rates, what we're seeing is this insatiable demand for higher quality credit continuing to flow, and that is creating unnaturally tight spreads. We always look at what we'll call that triple C double B basis as the ultimate arbiter for risk tolerance in the market at any given point in time. The only way to have outsized returns is to drop lower down in the credit quality and spectrum. Arguably, you're not getting fully compensated for the default risk that could be coming in the market. And obviously this is what creates credit cycles. And so as you think about the ability to arbitrage between those two markets, what we're seeing and as it relates to the private credit market, particularly on the credit solutions side of the business, we really look at that as a little bit of a hack on this yield versus spread debate, in the sense of you get the benefit of the base rate. We don't see the tightening of spreads in that market. And so you're able to get really attractive coupons, and then with OID and call protection, that gets you to attractive returns. And we think that's a really interesting arbitrage that we're seeing right now between that spread and yield debate in the public and the private credit markets. We keep talking about the ramification of higher rates and what does it mean on these various sectors. That is definitively hurting affordability in the housing market. Juxtaposed to that is this massive undersupply of housing that we see in the United States today. We have been significantly deficient of that post the global financial crisis, and you have these two dynamics that are working against each other, where there's significant demand out there, pent up demand, and there's not enough supply. What does some of that mean, and who ultimately are going to be the winners here? We really like the residential home builders, and the reason why is somebody has to build those 2.5, 3 million homes to make up for the undersupply of housing that we're seeing. And so while we're not extrapolating out a significant amount of price increases, we do believe that there's going to be significant and continued volume increases. And every time that we see one of these housing cycles, these larger public builders continue to take more and more market share as they're able to deliver these incremental homes. We think that there are a couple of really unique angles with which to play the opportunity that is created in retail. The first is through the liquidation side of things and ensuring that you have the capabilities to invest and be secured by inventory, accounts receivable, etc. I think that you're going to see continued demand from capital in that space when and if retailers fail. The other way that we really like playing retail right now is in the brand space. And it is very difficult to build a brand at this point in time. And brands have significant power in the market. And so if you think about our thesis in retail over the last decade, brick and mortar will ultimately be the losers, brands will ultimately be the winners. And so brand management companies accessing the IP, capitalizing on that brand, not taking inventory risk, not taking risk on retail stores with leases, and ultimately, I think within that retail space, whether it is through that liquidations or that brand management, those are the two most compelling risk returns that we see in a space. This is the benefit of having private credit, being able to structure these, having these unique relationships to capitalize on these trends that you really don't have that capability in the regular way public market.